Okay, it gives me great pleasure to bring on board Pankaj Jaju, founder and CEO with Metta Capital Advisors. Pankaj, welcome to ET Now. It's your first time I'm interacting with you, at least on this forum. So lovely to connect with you. We've been having off the records conversations, but today it's good to have you on TV.
Thank you. Pleasure to be here.
Is this your first time on TV?
No, not at all.
Great. It's your first time on ET Now, at least on this show. So welcome once again.
Thank you.
Let me start with the very basic question. What is your market view? Why are markets just rushing from one end of the range to the other end of the range? I mean, crude is now behaving like mid-cap.
I think volatility is here to stay. When there is uncertainty and people are trying to form a view, excesses happen, people move from fear to greed. And in markets like this, where you are seeing news emerging every day, on every front, whether it is domestic markets, elections, geopolitics, you will see things like this happen.
So do you think we are in for this kind of a market where the index will remain volatile, but beneath the index there is going to be a very strong specific bull market which will continue to persist?
I'm a strong believer in that markets is one, but you have to look at specific companies, industries, where things are changing, where there are trends emerging, and stay with those. And there are people who do ride up and down, are able to time the market. But for those who can't, the best thing to do is to stay put. Find a good company, find a good sector, great management, buy the stock and sit with.
Okay. Pankaj, one of the core areas where you specialize and historically you've really mastered the art of understanding trends is the retail sector. I'm going to start with a very basic question. How should one understand the retail appetite? One side, there is this famous unlock trade. All of us are going to malls, we are buying shoes, we are buying clothes. That retail therapy experience is back. But every time when we are picking a piece of garment or a shoe from a rack, what is biting us is, oh my God, how expensive they are. How does that translate into demand and supply scenario and opportunity for companies?
Yeah, I think at this point of time, inflation is here to stay and cost of doing business has gone up. But at the same time, if you have to spend, you have to spend. And reality is that income levels have also grown up. And especially for India, we are actually moving from being able to sustain ourselves, with a per capita GDP being low, to for the first time getting out into discretionary spend. And hence, inflation, of course, will probably cause a dent in the demand. But reality is that there is a pent-up demand, and with greater affluence, greater aspirations, people are going to spend. So I don't see a reason why retail cannot grow faster than 12, 13, 14% year on year. I mean, if you just look at GDP growth, add inflation, and at least that is the level of growth plus that you should see overall in retail. And within that, in the categories that you spoke about, people going into organized retail malls, they will take away some share from unorganized. And hence that should grow faster if I were to look at the next 5 to 10 years.
So Pankaj, as organized takes away share from the unorganized, in the middle of all of this, of course, we will have the online e-commerce play as well.
That's right. So, new channels of consumption are emerging, and it's visible across all facets of our lives. What it would really mean is that the customer is seeking convenience, wanting to either stop and walk into a store, buy on the road, buy online. And all of these channels will grow. But the reality is that the market is growing faster. So if I were to look at the overall retail pie, and if it's growing at, let's say, 13 to 15% year on year, within that, there is unorganized, which may probably lose some share, but not in absolute terms, and e-commerce, which will grow faster and hence take away share. But it's taking a part of the growth and not really beating down what is going to happen offline. And one very clear example is the electronic. Look at some of the large players who are present in electronic retailing. 3 to 4 years ago, people thought they'll all shut down, whether it's a Vijay Sales or a Chroma or a Viveks. But reality is that customers have adapted. People want to walk into stores to experience the product. They want instant gratification. They want to buy it there and now. And brands have also realized that they need both channels to survive. So while e-commerce has become a large player for all of us buying our TVs and mobiles, offline retail also continues to grow.
Okay, omni-channel, multi-channel approach, that's what the brands, of course, are taking up as well. Pankaj, of course, this will be a long-term idea, I'm guessing, that you're betting big on, because, we're also talking on a day where Mengai is coming back. We're hearing about, if you look at the way the bond markets are indicating a recession that is coming in, we may see more supply disruptions as well as China goes into lockdown.
Yeah, this will be a long-term trend. There will be ups and downs and disruptions. And companies will have to evolve their business models. People who are unable to adapt will face problem. I mean, if you just look at the banking sector, 5 years ago, we all thought that fintechs coming in, what will happen to banks? Reality is that several banks have embraced digital and come back strongly. Some who weren't able to struggled and are now trying to get their act in place. So same will happen with consumer and retail.
Pankaj, but the problem with these fashion retailers, and I'm purely picking up the apparel ones right now, first is that it's a very limited space. I mean, you have a wide range from a Shopper Stop to a Trend to an Aditya Birla Fashion, players like a TCNS. I mean, I'll include V-Mart also, chalo, in that, Go Fashions and Vedant Fashions, for instance. So A, wide scale, B, very limited few players, and C, all of them have run up already so much. For someone who's actually jumping into the trade only now, I mean, year to date, most of these stocks have already given you 34, 20 odd % kind of returns. Won't valuations be a concern?
One will have to look at stock specific. Reality is that if I were to look at what can these companies do 5 years down the line, some of them are growing at 20, 25%, some are growing at 10 to 15%. There are companies which have 30 to 40% EBITDA margins and ROCs which are great. Those companies are already getting richly valued, but the growth may sustain those valuations. On the other side, there are certain companies which got beaten down because in COVID, people thought that, with COVID plus online retailing coming back and most of the retailers having fixed costs, whether they will survive or whether they can get their act together. Now, those are places where there may be deep value, where an investor can make a call on whether these companies will be able to embrace Omni the way customers will want going forward, and take a call. And hence there would be value available in some of these companies that you spoke about, even though they've gone up by between 25 to 50% over the last year.
Point. The other space, Pankaj, I want to talk about, which you also track very closely, is real estate. Now, start of 2021, when you had that solid purchase data coming in, at least from the mega cities, including Bangalore, Delhi and Mumbai and the rest, you had interest rates which were at an all-time low. You had also some of the benefits being dished out by state governments like Maharashtra, wherein there was that stamp duty cut, which acted as a big kicker for some of these realty sales. But now in our conversations, I mean, for instance, we were chatting with Godrej Properties just yesterday, and they said that inflation is hitting them hard as well. Their input costs are also going up, and now they are looking at upping prices by about 10 to 15% pretty much across the board, and that is what all and every report seem to be indicating. Do you think that's going to dampen housing sales per se?
So if I were to look at the long-term trend for housing sales, COVID has taught all of us that having one extra room or a house where the family can really be comfortable is extremely important. And that's what's brought back housing sales. Lower interest rates, which are still remain low, EMIs being low, and on the other side, incomes having improved. And over the last 7-8 years, housing prices not really having moved, has improved affordability like anything. Yes, some level of price increase can dampen sales, but one must also bear in mind that the moment prices start moving, though, of course, if it's to the extent of 10% and plus, will hit. But if there is a marginal increase in price, people who are sitting on the fence actually jump in to buy. And we've seen that, across cycles, that when prices start moving, volumes start going up. But I would think that yes, short term there could be a impact on sales, but in the long run, the fundamentals are pretty strong and there are very strong tailwinds for the housing sector as a whole. And if on top of that, you were to add the fact that RERA has helped consolidate the industry and capital availability for small and marginal developers has gone down. For the larger players, there is also gain in market share, which is going to happen.
But Pankaj, the grain of the truth here is that you spoke about ROS and capital returns for retailers. Where is that in real estate? Not even double digit. And I'm talking about big builders here.
That's true that, return on capital employed has lagged, for most developers in recent times. But if I were to go back historically, real estate is a sector which afforded developers to raise capital at levels of, 18 to 20 to 25% because the IRRs existed. The issue with most developers was that people went and bought large tracts of land, and those land parcels are not generating returns. Now you're sitting on land which probably is appreciating at single digits or thereabouts, and your ask on capital is double digit. You have a classic situation where it's a negative carry, and that's really been the impact. But if you were to talk to developers and look at some of the projects that they are doing today and look at the project level IRRs, those are in reasonably good double digits.
So
On a
Pankaj, let's
portfolio as a whole, I guess as people consume some of the excess land they have, and as the business gets into a proper cycle, I think you will see ROEs and ROCs come back.
tell us about your style of investing. When you invest, do you use time as the benchmark of deciding the portfolio? Okay, this is the portfolio for 3 year, 5 year, and 5 year beyond, or is it purely based on cyclicality and compounding belief?
Cyclicality, no. Though cyclicality can offer you great opportunities to get into businesses at attractive prices. I would typically take a 5 year view, see where the industry can go, where the company can go, and if the management is great. I mean, for example, if I look at real estate, the market cap of the entire sector is less than 3 lakh crore, which is 1% of India's market cap. And on the other side, if you look at the sector as a whole, it's 6-7% of GDP can easily be double digit of GDP. Now, will value get created there? Will some developers become very large? Yes, they will. And hence, can you take a call on some of those? Yes, you can.
Will buy for 3 to 5 years and even beyond. What else qualifies that cut? Because the minute you start increasing the time horizon, I'm just saying this for the benefit of our viewers, then this whole notion of what is mehenga and what is sasta changes, because time changes your entire terminal value. So real estate is one where you think you want to buy for long haul. What else makes to that cut?
So personally, I buy for the long haul only. And even in retail, the other sector that we spoke about, there are opportunities there where one can take a 5 year view, saying that if these companies can become omni, if they will be relevant to the consumer, the management understands what it takes to make this transition, then the gap between the online and offline has to merge. I mean, today online players get valued at stratospheric levels. And on the other side, offline retailers who've created their brand, the entire real estate, the presence of stores, which cannot be easily replicated over the last 2 decades, get a fraction of that value. The customer is not going to say, I'm buying at an online retailer or offline retailer. I mean, Lenskart, First Cry, all of them have, large number of offline stores. Nykaa has offline stores. So just as when we go to a bank, we don't say we want a branch or we want an ATM or we want an app or a website. We, use it wherever we want to. Similarly, a customer will want to shop anywhere. So there will be a convergence that has to happen, and one has to take a call in terms of which of the offline guys will be able to make that convergence.
View on value retailing. There is a V-Mart on one side and there is a D-Mart on the other side.
Sorry, I missed the question.
No, I'm saying, what is your view on the value retail? In India we say, Sasta Sundar Tikau. That famous line from IKEA, that till the time Indians will prefer money over time, the business of D-Mart and the business of V-Mart will be will always be in demand, because Indians are price conscious and less time conscious. Do you think a V-Mart and a Deep Mart should be part of everyone's compounder portfolio?
So as businesses, these are fantastic businesses run by great managements. Both companies have understood what it takes to serve the bottom of the pyramid and the strata of society which is price conscious. I'm not sure whether this is a trade-off between price and time, because the person who's going into a V-Mart was earlier buying in the village heart. He didn't have the opportunity to walk into a store and get selection. And this is somebody who buys, a few shirts, possibly washes it 50 times, needs the apparel to be looking good even after those many washes. So it's a different kind of customer, and similarly with DMart. And that segment is going to continue to grow. We just scratched the surface. In terms of consistent compounders and valuation, I don't want to make a comment, but entry price is extremely important. Of course, time and compounding helps if you were to get in expensive, but if you can get into something at a better value, that's much more better for you.
Okay. Pankaj, great to have you on the show today, and we should talk more often about all the themes that you spot in the market.
Thank you. Pleasure being here.